Coming up in today's show, stocks close out a strong month, with the Nasdaq having its strongest first 7 months of the year since 1975. Buffett's favourite market indicator hits significantly overvalued levels. America opens the first nuclear reactor in 7 years. Oil finishes July up 16%, and BlackRock CEO sells more shares. Welcome back to the Click Capital Daily Show, everybody. I hope you had a great weekend. My name's Jared, and I'm going to run you through all the most important news, data, and charts from the markets today. And it's the last day of July. We finished out pretty strong here on what's been a strong month. It was only really the defensive sectors, healthcare, consumer defensive, and utilities that we've been seeing a bit of weakness, and a bit more strength in the financials and consumer cyclicals and tech. And so after that strong July, we are now having a very strong first 7 months to the year. In fact, the Nasdaq has outperformed the Dow Jones Industrial by its widest margin ever, coming in just above 30% year to date, and that's even higher than what we saw back in 2020. When tech stocks ripped hard after COVID lockdowns by 27% at the same point of time in this year. And that's got Wall Street analysts upgrading their price targets for year end and year out targets, with Citigroup being the latest, increasing their previous target of 4,400 on the S&P 500 to a target of now 5,000 by the middle of next year. And that's largely thanks to the Magnificent Seven: Apple, Amazon, Google, NVDA, Tesla, Microsoft, and Meta, which now make up nearly 30% of the S&P 500. But in the last month or two, we have seen a broadening of breadth in the market, and we have seen a lot of other stocks catching up. And we've even got long-term market observer, Wharton professor Jeremy Siegel, saying the stock market has headed to new all-time highs thanks to a strong economy and resilient corporate earnings. He said lower inflation, stronger economy, good guidance, good profits. What's to stop this market now? And he's probably right, because we're just 4% away from the all-time high, just under 4,800. And economic data has been trending in the right direction. And Q2 earnings seasons, which we're in the thick of, is coming in a little bit better than expected as well. Even the biggest bear on the street for much of the last year, Morgan Stanley's Mike Wilson, has even turned bullish and has admitted stocks have fared a lot better than he thought this year, and said now stocks are in the middle of a pivot rally that still has room to run. He said the data we have today suggests that we are in a policy-driven late cycle rally, and has even compared this market to like 2019. Those were the bullish arguments. Over to the bearish arguments, and this one's a bit more of a long-term indicator, and is actually Warren Buffett's favorite indicator to measure the valuation of the overall stock market. And that's by looking at the total market cap of the stock market versus the GDP of the economy. And that's surged up above 171%, which we can see here on this 1 year chart of the US total market cap versus its GDP. And then just looking back out at the last 3 years, at the height of the last bull market in late 21, we did get a bit above 200% on this indicator. However, if you look out to all data, going back to 1980, almost 45 years ago, you can see this number is well above the long-term average, which is somewhere around 100, and is much higher than the peak we got into the tech bubble in the late 90s, early 2000, when it hit a high of 145%. However, the counter argument to this, and we hate to use the term why it's different this time, but let's just entertain that possibility for a second. Since 2008, the Federal Reserve took their balance sheet from $1 trillion to almost $9 trillion, basically creating money out of nothing and adding it into financial markets. And also in this time in the US market, we've had the emergence of mega cap tech and their global dominance. And so you could think of the Magnificent Seven as global companies. And since they make up such a large percentage of the market cap, maybe measuring the market cap of those companies versus the GDP of just the US economy doesn't make sense. Maybe it should be measured against the global economy, because that has been a huge dominant theme over the last 15 years, is American mega cap tech stocks dominating the global markets that they participate in. However, if it's not different this time and we do get a reversion to the mean, that means we're either going to have to see explosive growth in the GDP, or the market cap could have a nasty correction back down towards 100% of GDP. Not only is the stock market richly valued onto itself in historical terms, it's also really overvalued in relation to bonds. When you look at the S&P 500 earnings yield, premium over inflation protected treasuries, we're now down near 20-year lows. And if this guy here keeps hiking rates, then bonds are going to continue to offer a higher and safer yield versus stocks. Not unless stocks can really grow their earnings at a much faster rate. And with the biggest bear on the street turning bullish, we've also got the biggest bull on the street turning bearish. With Fundstrat's Tom Lee saying investors should brace for an August stock market slump. He cited some statistics like, since 1950, the average return for the month of August has been just 0.01%, making it one of the worst months. During that period, the win ratio for the month has only been 55%, and when stocks do fall in August, average drawdown is 3.2%. And another interesting stat on top of that is stock market underperformance in August worsens when the S&P 500 has gained more than 15% through the end of July. The average return falls to minus 1.4%, win ratio declines to 40%, average drawdown increases to 3.5%. And that is true. Over the next couple of months is a seasonally weak time for the stock market, and we have been on an absolute parabolic tear higher, so it wouldn't be that surprising for us to get a bit of a 5-10% correction here over the next month or two. We also got some economic data today showing the Eurozone might be slightly escaping its technical recession by a little bit, with GDP growth in the second quarter coming in at 0.3%, a little bit higher than the 0.2% analysts expected. But they've still got headline inflation at 5.3%, well above growth and their long-term target. On the other hand, we've still got China's factory activity contracting for the fourth straight month, with their PMI index coming in at 49.3 for manufacturing and their non-manufacturing PMI coming in at 51.5. In other news out today, we've also got America opening their first nuclear reactor plant in nearly 7 years. It's in Georgia and has already started operation, will power approximately 500,000 homes and businesses with clean energy. And nuclear has always been the most efficient, clean form of energy if it's well run and managed and you don't build the plants next to the sea. Unfortunately, like Japan did, resulting in their nuclear accident in 2011. Then the world kind of turned their back on nuclear and started deleveraging from it. And you can see that in the huge fall in the price of uranium since 2011. However, we bottomed out in 2020. And just looking at the weekly chart here, we had quite a good rally in 21, pulled back a little bit in 22, and been consolidating now for the last year. However, just looking at the daily chart here, we do some good price action in the short term, and uranium actually finished up 3.2% today on above average volume, close to multi-month highs. And just like gold, I am a long-term uranium bull as well. And we have been seeing a strong bid in oil as well, finishing the month up 16%, coming in with its best month since Russia invaded Ukraine. On the back of cooling fears of recession, plus news that China is doing big stimulus to try and increase growth in their economy again. And we've also got support from the Biden administration needing to replenish the strategic petroleum reserve after depleting it significantly over the last 2 years. And we can see that in the daily price action of crude oil futures, now in a strong short-term uptrend, and looks to be walking the line on our buy-sell bands here. But like I said, the next big resistance is in the mid-80s. Just taking you out to a weekly chart, we need to close above that mid-80s, put in a higher high, higher low. Then we can say crude oil is back into an uptrend. And this too should put upward pressure on inflation, as crude is such a big input into the economy. And not wanting to miss out on the secular shift from combustion engines to electric vehicles is ExxonMobil, who is in talks with car manufacturers to become a lithium supplier and supply to Tesla, Volkswagen, Ford, and even Samsung. And they're already drilling for lithium. And this looks like moves from the world's second biggest oil producer to kind of hedge their business a bit and looking to benefit on the structural shift to clean energy. The market appeared to like that news, sending ExxonMobil shares up 3% today. And that should also be good for Tesla and others, as the cost to make batteries is still very expensive and the number one hurdle to get over to really beat fossil fuels and combustion engines. And so the more competition and suppliers of lithium, the better that should be for the big consumers of it like Tesla. We also got news from the SEC on Friday that BlackRock CEO Larry Fink has sold another bunch of stock worth about $15 million. And this is on top of the $25 million worth of stock he sold back in mid-April, significantly bringing down his stake in the company. And as the number one person at the number one asset manager in the world, that could be a little telling. And just looking at the weekly chart here of BlackRock, you can see we have been consolidating sideways for a bit over a year now, and looks like we may have rejected a little bit off this $750 resistance zone here. And just a quick look at some economic data from around the globe today. We've got retail sales in Germany still contracting year over year. Italy's GDP growth rate contracting quarter over quarter. There's the Eurozone growth rate coming in a little bit better than expected, but still high inflation. They're not much out from the States today. And we'll also get news from the Aussie Central Bank out later today, with them expected to increase their rates 0.25% to 4.35%. With the market hoping that's the end of the cycle as well. And just a quick look at tomorrow, we've got some PMIs coming out from around the world, and not much else due out the rest of the week, except for Friday going into the big one. That'll be non-farm payrolls. Fed Fund Futures still pricing a 1 in 5 chance they'll hike in September, and a bit below 1 in 3 chance they'll have it done by November. No surprise from the Fear and Greed Index, and a typical soft start to the week in the options market, still really lopsided with 58% calls. And there's the Dark Pool Index again, decreasing today and continuing this divergence and pullback from the market. Same deal with Corporate Insiders, not purchasing much of their stock at all here. Okay, back into the charts, we've got the S&P 500 just under 4,600, really close to year-to-date highs. And the winning index today was actually the Russell 2000, breaking out to new year-to-date highs. But just taking you out on a weekly chart, and that is coming up to resistance zone as well, where we've turned back in February and August last year. And across global stock markets, pretty flat for a Monday. Slight tick up in the VIX to 13.6. Short-term breadth still holding up a little bit with 67% of stocks above their 20-day average. Still not breaking out with the amount of stocks making new highs. Growth versus defensive sectors looks to be holding onto its 50-day. And small caps continue to hold their own versus large caps. Copper versus gold spread continues to hold above its 50. Government bond yields basically flat. Dollar index sitting right at its 50 at 1016. Bitcoin closed below its 50. And commodities overall continue to trade well. And over to stock sectors, the winner today is the meme stock ETF with continued strong performances in the sector, which I'll get into soon. And we got a nice continuation on the bounce we saw in the cannabis ETF on Friday, now almost back at its 50. There's overvalued stocks still doing well, as are clean energy and traditional energy, oil and gas strong, and gold miners trying to hold above their 50 as well, with the price of gold now back at 2,000 an ounce. And the defensive sectors, healthcare, staples, and utilities, still a little soft here. And just a quick look at our sector trends table. After we saw a bit of red up the front last week, it's gone back to green now. So it looks like it might have been a little bit of a short-term pullback. And we've only got 2 sectors below their 20-day average and 1 sector, biotech, below its 50-day average. Over to popular stocks, still got JP Morgan trading strong, and no big movers out of mega cap tech today. They're all just a little bit flat, except for Meta, which came off 2.1%. And meme stocks, there's Tupperware again, ripping 38% higher today. Day traders have definitely got a hold of this one, 172 million shares traded. And most other meme stocks doing well today as well. There's Virgin Galactic up almost 9%, Beyond Meat 8%, Peloton 11%, and Nikola 17%. As we got another surprise order from them, from JB Hunt Trucking, ordering some Nikola trucks. So it looks like they are coming back from the dead. And another big move up in SoFi on the back of their earnings, 20% higher. Another strong move up for Roku after their good earnings Thursday afternoon, another 7.4% today higher. And a little bit of a pullback in the regional banks, but the big guys still holding in there pretty good. Okay, that pretty much wraps it up for today. Bit of a quiet start to the week here, and the grind higher looks set to continue. Thanks very much for tuning in, and I'll see you all again tomorrow.